Section 1245 is the rule that turns part of your gain into ordinary income. It applies to depreciable personal property used in a trade or business. Think equipment, machinery, vehicles, and certain livestock. It's still generally Section 1231 property if held over 1 year, but Section 1245 recaptures depreciation first. On the EA exam, they test whether you can spot Section 1245 property quickly. Here's the big idea. When you sell Section 1245 property at a gain, the gain is ordinary income up to the depreciation or amortization you took. Only after you recapture that depreciation can any remaining gain be treated as Section 1231 gain, which may get favorable long-term capital gain treatment. The exam loves the phrase, to the extent of depreciation allowed or allowable. Use a simple workflow. Step 1. Compute adjusted basis. Original cost minus accumulated depreciation. Step 2. Compute total gain. Amount realized minus adjusted basis. Step 3. Recapture. Ordinary income equals the lesser of total gain or depreciation taken. Step 4. Whatever gain is left is Section 1231 gain. If it's a loss, Section 1245 recapture doesn't apply. Losses generally stay Section 1231. Let's do the bulldozer example. Cost was $90,000. Accumulated depreciation is $40,000. So adjusted basis is $50,000. It sells for $112,000, so total gain is $62,000. Recapture is limited to depreciation taken, so $40,000 becomes ordinary income under Section 1245. The leftover $22,000 is Section 1231 gain, potentially taxed like long-term capital gain if the taxpayer has net Section 1231 gain. A classic exam trap is thinking, I sold it for more than I paid, so it's all capital gain. Not with Section 1245. In the box truck example, the truck was depreciated to zero. If it sells for $11,000, the entire $4,200 of original cost that was depreciated gets recaptured as ordinary income first. Only the extra $6,800 is Section 1231 gain. Depreciation deductions gave a prior tax benefit. Recapture clause it back. One more boundary. Buildings are not Section 1245 property. Real property is generally Section 1250, with different recapture concepts like unrecaptured Section 1250 gain. So when you see office buildings, warehouses, or apartments, your brain should shift away from Section 1245. When you see equipment, computers, machinery, or business vehicles, think Section 1245 recapture first, then Section 1231 for any leftover gain. Bianca owns a dog grooming business as a sole proprietor. This year, she has gross receipts of $63,000. She paid $6,000 of wages, had $7,200 of supplies, and $1,500 of utilities. She also has a $2,200 Section 1231 gain from selling equipment, and she made a $3,100 charitable contribution. How much business income should she report on Schedule C? Think about it. The answer is $48,300. Schedule C income is gross receipts minus ordinary and necessary Schedule C expenses. $63,000 minus $6,000 minus $7,200 minus $1,500. Don't subtract the charitable contribution on Schedule C. That's generally an itemized deduction. And don't add the Section 1231 gain here either. That's generally reported on Form 4797 and may flow elsewhere. The tempting wrong move is netting everything together. Which of the following is not Section 1245 property? Livestock held for breeding purposes, farming machinery, an office building, or computer equipment. Think about what counts as depreciable personal property versus real property. Think about it. The correct answer is the office building. Buildings are real property, generally Section 1250, not Section 1245. The other choices, breeding livestock, farming machinery, and computer equipment, are depreciable business property that fits the Section 1245 bucket. On the exam, building is the giveaway word that should push you away from Section 1245.